don't buy US stocks, don't hold US dollars. You know why? Because the US national debt has now topped 35 trillion for the first time, and it keeps going up. And this US debt bubble or bomb is not sustainable. Eventually it's going to collapse, and if you hold US stocks, US currency, you're going to lose everything. That's the message that all these gloom and doom articles are telling you, and increasingly more in the last 1 or 2 years. But you know something? This is nothing new. I've heard the same story being said again and again for the last 10 to 20 years, especially during the great financial crisis of 2008 and 2009. And if you look back at history, for example, in 2011, a lot of people got very scared because for the first time, the Standard & Poor's, they downgraded the US debt from AAA rating to a AA rating. And yeah, initially there was a bit of a sell-off in the markets that was right there in 2011. And then in August 2023, Fitch, another ratings agency, downgraded the US long-term debt as well, saying that the US government debt is not as secure as it once was. And of course, early this year, Moody's also lowered the US credit rating from positive to negative. But despite all that, what happened to the stock market? The stock market kept going up. In fact, ever since that first ratings downgrade that freaked people out, the S&P 500 is up over 384% return. So listening to all these scary doom and gloom news about the national debt would have caused a lot of people to miss out on huge gains in the US stock market. Now, the thing that many people fail to realize that you must understand is that there's a big difference between US government debt and corporate debt. All right. So yes, US government debt is scary. It's going up like crazy. But I don't invest in the US government. I invest in US companies. So remember that when you buy US stocks, you're buying US businesses. And what you need to pay attention to is the debt of the US businesses, not the debt of the government. They're two separate things altogether, right? And if you take a look, for example, most of the companies that I invest in, like I invest in Alphabet, which is Google, Microsoft, Meta, Nvidia, the majority of the companies I buy, they have little or no debt. They've got a lot more cash than debt. So in other words, even if the US government goes bankrupt, theoretically goes bankrupt, I don't care. I don't give a shit, right? Because I'm not investing in the US government. I'm investing in US companies. And as long as the US companies keep growing their revenue and their profits and they got little or no debt, I'm going to make a lot of money as they increase in value. Now, of course, if the US government indeed goes bankrupt, which is a very, very, very low possibility. But even if they do go bankrupt, yes, it will affect US stocks, but not all US stocks. It will affect certain US stocks, but not other US stocks. So in this video, I'm going to talk about two things. Number one, I'm going to talk about whether this US national debt is sustainable. Number one. Number two, if it's not sustainable, what are the repercussions? What is the worst case consequence to us who own US stocks? So let's start by tackling the first question. Is the US national debt, which is increasing, is it sustainable? So the thing to understand is that how does the US government borrow money? They borrow money by selling government bonds, known as treasury bonds. So if I buy a government bond, that means I'm lending money to the US government and they pay me a fixed interest rate, and eventually when the bond matures, I get back my principal, right? Okay, so who buys these government bonds? Well, there are three groups of people. The first group are the US government themselves. That's right, they buy from themselves. This is known as intra-governmental debt. So these are treasury bonds or government bonds that are held by government agencies, including Social Security. So in other words, this is the money that the government owes itself. So left pocket, right pocket. And that makes up 28% of all the debt which they basically owe themselves. All right. Now, then another 39% of these bonds are owned by US citizens, as well as the Federal Reserve, which makes up 39%. So US investors could be individuals and US corporations. In fact, Warren Buffett is the biggest holder of US debt as an individual and as Berkshire Hathaway, right? And out of the 39%, 1/3 of this debt is held by the Federal Reserve. The Fed holds 27% of all the domestic debt. And the last 1/3 of government debt is owned by foreign investors, people like me or you who are not US citizens, as well as foreign governments. And you can see the rough breakdown. So Japan owns 6% of the debt, China 5%, the UK 3%, and all the other countries and all the other people own 19%. So is this debt sustainable, and is there too much debt? Well, there are a few metrics you can look at. What people like to look at is the debt to GDP ratio. So comparing the total debt of the government to the GDP of the country, the output of the country. So yes, it has been rising, as you can see, over the years, and right now it is at 120% debt to GDP ratio, which means out of $100 of GDP or output of the country, the government owes $120. So is this considered high? Well, it's relative. If you compare to other countries, yes, it's high, but it's not the highest. So relative comparison, Japan has a debt to GDP ratio of 261%, which is double that of the US. Greece has 177%, Venezuela 157%, Italy 144%, and the US comes in at number 5, highest at 121%. But I can tell you this, the debt to GDP ratio is not really the best measure of sustainability. Why? Because it doesn't matter how much debt they have at one go, because they don't have to pay back all the debt right now, right? And number 2, the US government doesn't use GDP to pay back the debt. They don't. So how do they pay back the debt? They have to pay interest and the principal back, right? So how they pay the principal back is they issue more bonds. They issue more bonds and they take the money from the bonds to pay off the bonds that have matured. That's how they repay back the principal. But what is important is paying the interest on the debt. As long as they can pay the interest on the debt, then it is sustainable. Okay, so how do they pay interest on the debt? They do it by collecting taxes from the people. Corporate tax, income tax, tax revenue. Part of the tax revenue, they pay interest on the debt. As long as they've got enough tax revenue to pay the interest on the debt, it is sustainable. So what is the interest payment as a percentage of tax revenue? So this is the chart that is the most important one. Currently, you can see 32% of the government tax collections are used to pay interest on the debt. So is this considered very high? Is it considered unsustainable? Well, if you compare it to history, you can see that it is not the highest point, right? So right now we're 32%, but if you take a look at the 1980s, the mid-80s and the early 90s, this percentage went all the way up to 45% to 50%. And if you take a look at history, the 1980s and 1990s, even though the tax burden was a lot higher than it is today, based on this metric, the stock market did really well. In the 1980s, 1990s, the market had one of the biggest bull runs in history. And that's why it goes to show you that, you know, the debt can go up, the interest payments can go up, but the stock market can do very, very well. Now, what is the thing that could cause this to again go back up to that level where it again becomes scary? It is when treasury bond yields go up. That is what would cause this to increase. And that's why one of the things that we need to watch is the 10-year government bond yield. Now, of course, we also look at the 2-year yield, the 5-year yield, the 10-year yield, the 20-year yield, all the yields, right? But the one that most people look at is the 10-year yield, for example. So if this yield basically tells you, right now the yield is 4.24%. So that means that when a government sells bonds, 10-year bonds, they are paying 4.24% interest on the bonds. And so if this goes up too much, back to 11, 12, 13%, then of course that could become very scary. The amount of interest the government got to pay on their debt, okay? But look at where it was. Again, you can see in the 1980s, if I zoom here, right, in 1980s and 1990s, my God, the interest rate on the government debt was at the time 10, 12, 13, 14%, okay? But despite that, take a look at the S&P 500. Look at the stock market. The stock market had one of the strongest bull runs in the 80s to 90s. Again, it doesn't mean that the stock market cannot go up even when the government has very high interest rates to pay on their debt. So if you take a look again at the 80s and 90s, when their interest payments as a percentage of their tax receipts was at a crazy 45 to 50%, you can see that during that time, the stock market, the S&P 500 in the 80s to the 90s rose 910%. So again, remember that the stock market, which is made up of businesses, is not the government. The government can screw up, but companies can do very, very well. So in answering that first question, is the debt sustainable for now? I think it is. But what if it is not sustainable? Let's look at the worst case scenario. Now, what do I mean by not sustainable? Does it mean that the US government will default on the debt and not pay what it owes or not pay the interest? No, I think that is almost an impossibility. Why? Because the US government, remember, it borrows money in US dollars, but it also prints US dollars. So if the US government can print US dollars, then they can never default. It is impossible, unless of course Congress doesn't want to increase the debt ceiling, which is more of a political issue, right? But as long as they keep increasing the debt ceiling, they can forever pay their debt. They can never default, okay? Now, however, what could happen if they keep printing money and, foreign investors start to get nervous and they say, but, they keep printing money and, the debt balloons and I'm not going to hold debt anymore. So there could be a fall in the demand for government debt. So that is what I mean by not sustainable. So let's look at the scenario, the repercussions of that, right? So number one repercussion, if people start to not want to buy government debt anymore, so there's a big fall in government debt, what will happen? Then government bond prices will fall. And if you look at a TLT, which is the 10-year treasury bond ETF, that will keep going down, right? So if government treasury bond prices fall, that means treasury yields or interest rates will keep rising. For now, it's 4.25%. If it goes to 5%, 6%, 7%, 10%, like it was in the 80s, then what would happen? That would increase the borrowing cost for businesses and consumers. Remember that when you take a bank loan as a consumer, or if you own a company, you take a loan, all the interest rates are priced off the treasury yield rates, right? So when borrowing costs increase, what will happen? This would negatively affect companies with high debt financing. So like I said, if the government debt is in trouble, not all stocks will be affected. Not all companies will be affected. The companies that will be the most affected will be companies that require debt financing, that need to keep borrowing money to finance their business, or they have a lot of debt. So what kind of companies will be in trouble? Small companies, small caps, industrial companies, energy companies, materials, commodity companies, and real estate companies. Because these type of companies, which are known as cyclical companies, they have a lot of debt on the balance sheet. So they are the ones that would not do well if the debt really is not sustainable, right? Also, companies that sell high-priced goods. So think of certain goods that in order to buy these goods, you have to take a loan. For example, if you buy a car, you have to take a loan for most people. If you buy a house, you have to take a loan, right? So with increasing borrowing costs, consumers would buy less of these kind of products. So which companies will get affected? Auto companies, property developers, and home builders. So if you believe that the government debt is not sustainable, that one day is going to come crashing down, then don't own these companies. Don't own auto companies, don't own property developers, don't own home builders, don't own small caps, don't own industrials, don't own energy, don't own commodities, because all these will suffer. So which companies will be immune to this? So stocks that have very little debt on the balance sheet, stocks of companies that have a lot of cash, that don't need to raise money through debt, and companies that sell products or services that are lower in price, that people don't have to take a loan to buy these products and services, they are relatively immune and safe. So can you think of some of these kind of companies? Think about it and I'll give you a list in a while, all right? So that's number one. Now the second consequence of the debt not being sustainable is that, okay, so if the government finds that, oh my God, no one wants to buy a debt anymore, so what's going to happen? They will have to increase taxes, right? They have to increase corporate tax and income tax to collect more tax revenue to pay the increasing interest on the debt. So with increasing personal and corporate tax, what will happen? Well, the repercussions would be, as a consumer, you pay more tax, that would lower consumer spending. You spend less on stuff because you pay more taxes, like in Europe, for example, okay? And of course, companies have to pay more corporate tax, that will lower the corporate profits. So which companies will be affected? The companies that will be most affected will be companies that sell, again, high-priced consumer discretionary items. Because, think about it, as a consumer, as a US consumer, if you have more taxes and less disposable income, you would prioritize. You would spend less on high-priced items that are a luxury, that are discretionary, like luxury goods. So they will suffer. But you still you will still have to spend on utilities, on necessities, on things that you have to pay for anyway. So those companies will do well, but the luxury kind of discretionary companies will not do well, right? Now, at the same time, companies that derive most of their revenue from the US would have to pay higher corporate tax, and they will suffer. But companies that are more multinational, where they make their money internationally, they would suffer less. Why? Because in my previous video, I talked about how many multinational companies, they use tax loopholes to effectively pay very little corporate tax, even though the US government increases the corporate tax rate, because they use all these loopholes, right? So again, companies like your Amazon, your Google, your Microsoft, your Meta, which are international, they will not be too affected by this. They'll be quite immune from this. Okay, third consequence or repercussion is austerity. And this is what happened to Greece and some of the European nations during the European sovereign debt crisis about over 10 years ago, right? Where the government is forced to cut spending. So if the government cuts spending, they cut funding, companies that are most affected will be companies that depend on government spending and or funding. So can you think of what kind of companies depend on government spending and funding? Defense contractors, your Lockheed Martins, your Raytheon, your General Dynamics, they have a lot of government funding, government contracts, right? Infrastructure companies like that build bridges, and companies that build roads and stuff like that, or even Caterpillar, these industrial companies. Managed healthcare companies will be affected because they get a lot of government funding, right, for the Medicare, Medicaid, and stuff like that. All that will be cut. So not to say that I don't invest in any of these companies. I do, but I keep my allocation not too high. In case this shit happens, the majority of my companies will not be affected. So I do own United Health, I do own Elevance Health, which are managed healthcare companies. But in this scenario, yes, they will be badly affected if the government has to cut their spending or funding. All right. Education companies will also be affected. So stocks that do not rely on government spending, again, will be immune to this. Fourth and lastly would be, the fourth consequence is this. So if the government has to keep, printing money in order to fund the increasing debt, that would of course cause the devaluation of the US dollar. So if the US dollar gets devalued, by the way, all currencies get devalued, all right? It's not nothing new. It's not something new. It's just that what if the US dollar gets devalued even faster? What would happen? Is that good or bad? Well, the answer is that are both pros and cons to that. It's not all bad and it's not all good. Okay, so let me explain. If the US dollar devalues at a faster rate, that would increase the prices of imports. So that could cause inflation in the US. As they import foreign goods, it comes at a higher price. However, a weaker US dollar would reduce the price of exports. So that is actually good for exporters in the US because that would make their exports more competitive, right? At the same time, a weaker US dollar will increase the revenue of multinational companies when the monies they make overseas are repatriated back to the US. So companies like Apple that make their money all around the world, like they make their money in Singapore, in the UK and Europe, when they bring their money back to the US, with a US dollar weaker, the Singapore dollars and euros and pounds would convert to more US dollars, and that would increase their revenue. which would increase their profits, which would increase their stock price, all right? So, in other words, a weaker US dollar doesn't mean weaker US stock prices. A case in point is, look at Japan. The Japanese yen has been one of the worst performing currencies in the last 10 years. It's been one of the weakest currencies. If you look at the Japanese yen versus the euro, you can see it has really collapsed, right? Here, you look at the Japanese yen versus the US dollar, it has also collapsed. So the Japanese yen has devalued significantly. But what happened to the Japanese stock market? The Japanese stock market is on one of the huge bull runs. What is interesting is that despite the rising government debt of the US and people saying the dollar is losing its status as a reserve currency, de-dollarization, but the facts do not show that. In fact, if you take a look at the last 10 years, the US dollar has been the strongest currency in the world against all other major currencies. The only other currency that beat the US dollar is the Swiss franc. So take a look at this chart which I just updated a couple of minutes ago. And this is the last 10 years. You can see over the last 10 years, the US dollar has appreciated 49% against the Japanese yen. The US dollar appreciated 40% against the Indian rupee, appreciated 31% against the British pound, appreciated 25% against the euro, appreciated 14% against the Chinese yuan, and appreciated 6% against the Singapore dollar. And like I said, the only currency which was stronger than the US in the last 10 years is the Swiss franc, that where the US dollar depreciated against the Swiss franc by 3%. So think about that. All the stuff you read in the media that the dollar is losing the status, dollar weakening, is full of bullshit. The dollar is still the strongest currency till today. The other big bullshit crap that you hear is that the BRICS countries are going to create their united currency and they're going to compete and eventually dethrone the US dollar. That is a pipe dream. So first of all, why? Let me explain. Now, what are the BRICS countries? The BRICS countries, are made up of Brazil, Russia, India, China, and South Africa. So in the first place, if you look at their economies have not been doing well as compared to the US economy, and their currencies have all been devaluating and depreciating significantly against the US dollar. If you look at the last 10 years, let's take a look. The US dollar has appreciated 122% against the Brazilian real. The US dollar has appreciated 94% against the Russian ruble. The US dollar appreciated 59% against the South African rand. And the US dollar appreciated 35% against the Indian rupee and appreciated 16% against the Chinese yuan. So individually, all these currencies have all been devaluing a lot more than the US dollar. Now, if they all come together into one currency, it's going to be even worse. Now, if you remember many years ago when the euro was first formed, they said the euro would dethrone the US dollar, but the experiment has not turned out very well. Okay, because again, the different European countries, they have got different economic performance, they've got different debt levels, and to bring them all together was a big problem, and it'll be even worse in this context. Why? Because if you look at these 5 countries, they've got different ideologies, they've got different economic growth, different debt levels, and in fact, for example, India is a democracy, Russia is a communist country, China is a communist country. Now, if you want to mix together the currencies of democracies and communism, it's going to be a really bad result at the end of the day. And remember that for a single united currency, you need to have a central bank. Okay, now, so who's going to own the central bank? Of course, China will say we are the strongest, the central bank should be in Shanghai. But do you think the Indians who are in democracy would allow their currency, which is a new BRICS currency, to have a central bank in a communist China? I doubt it, right? So if you tell me that the BRICS currency is going to be something, I highly doubt it. I think even if they do pull it off, it's going to be a huge failure. It's going to collapse. just like how the euro almost collapsed many years ago. So I wouldn't worry about that. So in a nutshell, is the US national debt sustainable? Well, for now, it is, because again, the interest payments out of the tax receipts are lower than they were in the 80s and 90s. But if it is not sustainable, and let's say the demand for US government debt falls and US interest rates go up significantly, and all that happens, which are the stocks that will be immune to this government debt bomb blowing up? All right, so these are the stocks that, if you're afraid it's going to happen, you want to own these stocks. These will be the safest stocks that are immune to a debt bomb in the US government, right? So these are stocks that would have more cash than debt, stocks that do not need to raise any more debt because they are self-funding. These are stocks that do not sell a product or service that requires customers to take a loan. These are companies that sell a product or service that is a necessity and a utility that people still have to spend on. These are companies that are able to pay low corporate taxes through international tax loopholes. And these are companies that benefit from a lower US dollar because of internationally earned income. So I'm going to give you a minute to think, what are some stocks that fall in this category, that meet all these criteria? So if you own these stocks, and even if the US government goes bankrupt in the worst case scenario, these companies will do very well. I'll give you a minute, or I'll give you a few seconds to think about it. Okay, pause the video and think about it. Have you thought about it? Okay, now, of course, there are quite a number of stocks. I'm going to just show you 5 of them that I think meet this criteria, that are really safe to own, in my opinion. I'm not recommending you buy it. I'm just saying that I own it, and to me, I can sleep soundly at night. Even if the US government goes bankrupt, who gives a shit, right? So what are these companies that meet all these criteria? Number 1 will be Google. Okay. Number 2 will be Microsoft. Number 3, Nvidia. Number 4, Palo Alto. And number 5, Meta. Now, I'm not saying there's only 5. There are many more, but these are just 5 of the examples. Why? Because these companies that you see here, number 1, they have got relatively very low debt. They have a lot of cash on their balance sheet, and they can easily pay off all the debt and be debt-free if they want to. And they do not have to raise any debt in order to finance their operations, because they are generating huge amounts of free cash flow. And their product or service they sell for consumers or other businesses to buy, they don't have to take any kind of loans. And in a way, it's kind of like a necessity. It's like a utility, right? You gotta use Google. You can't live without Google. We can't live without Microsoft. AI can't exist without Nvidia's chips. Companies have to use Palo Alto's cybersecurity services. It's a must. It's a necessity. We have to use social media. People all around the world depend on social media for their social lives, for their businesses. So these are companies that, to me, I own, and I feel totally safe owning them, right? So I mean, it's been a pretty long video, but I do hope it has addressed a lot of the concerns that people have had. And it's not a new concern, it's been a concern people have had for the last 10 to 20 years. Thank you for listening, and as always, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.